Buenos días, bienvenidos a la Fundación Rafael del Pino. Las Central Banking Series son un acontecimiento relevante, una referencia sin duda, una reunión de expertos que cuenta con una trayectoria consolidada. En definitiva, un foro de conocimiento sobre la economía global y el sistema financiero en particular, que en estos momentos cobra un especial interés dadas las particularidades de la coyuntura económica. Quiero empezar mi breve intervención agradeciendo al Global Interdependence Center y al BBVA su contribución en la organización de este encuentro. Asimismo, es justo destacar la colaboración de Manuel Balmaseda, Jorge Sicilia, Michael Drari y Gillian Fornito, que con sus ideas y su trabajo han contribuido de forma inestimable al éxito de esta convocatoria. Al mismo tiempo, quiero dar la bienvenida a la Fundación Rafael del Pino a todos quienes participan como ponentes o moderadores. Ellos son los actores principales, los auténticos protagonistas del encuentro de hoy. Y esta mañana, de forma especial, quiero agradecer la presencia de Kathleen Stephansen, vicepresidenta de programas del GIC, a José Manuel González Páramo, miembro del Comité Ejecutivo del BBVA, que me acompañan en este acto de apertura. Asimismo, nuestra gratitud se extiende a Charles Evans, presidente de la Reserva Federal de Chicago, a Luis de Guindos, vicepresidente del Banco Central Europeo y ministro del anterior Gobierno de España, que serán presentados y moderados por el profesor Rafael Repullo. Todos ellos excelentes economistas y expertos de primer nivel en relación con el sistema financiero y la economía global. Y, por supuesto, quiero dar las gracias a todos ustedes por su presencia entre nosotros. Tengo la seguridad que el acto será de su interés y ustedes, como de costumbre, contribuirán a enriquecer el debate. Solo unas palabras acerca de las Central Banking Series. Se trata de un encuentro anual, en este caso el quinto, que la Fundación Rafael del Pino tiene el honor de acoger y de colaborar en su organización. Nuestra pretensión, de acuerdo con el mandato del fundador, mi padre, es fomentar el intercambio ilustrado de puntos de vista entre expertos de primer nivel en relación con cuestiones económicas, políticas y sociales relevantes. En particular, en este caso, en relación con la visión de los bancos centrales sobre la situación económica actual, que muestra síntomas de desaceleración y está sometida a grandes dosis de incertidumbre en un contexto de complejidad creciente. Todo ello con la mirada puesta en una sociedad cada vez más global e interdependiente que se plantea nuevos desafíos. En definitiva, pretendemos que el debate sea de alto nivel, estamos seguros de que así será, y porque se desarrolla por expertos procedentes de las principales economías del mundo. Convencida de que alcanzaremos los objetivos previstos gracias a la colaboración de todos, les agradezco de nuevo su presencia entre nosotros y paso la palabra a Kathleen Stephansen. Muchas gracias.
Buenos días. That's about it. I'm Kathleen Stephansen, and I'm the Vice Chair of Programming for the Global Interdependence Center. I'm standing here because the Chair, Don Rissmiller, could not make it to this event this year, but he has been here in prior years. I would like to welcome you also to this event. But before this, I would like to thank our sponsors, the Foundation, and also BBVA. I would particularly like to thank our partners, Vicente Montes Gan at the Foundation, Jorge Sicilia, BBVA, and our fellow board member, Manuel Balmaseda, who have been working very hard to get this event going. So just a word on the Global Interdependence Center, or otherwise known as GIC. It was founded back in 1976 in Philadelphia and by Frederick Heldren, who was a prominent Philadelphia banker and philanthropist. And in the early years, the leaders were people like Professor Larry Klein, like Bill Dunkelberg, and many other known economists. And we are a non-for-profit organization that tries to provide a neutral platform for discussions of divergent views about domestic as well as international programming events. And we think that this mission is absolutely essential in order to promote the understanding and the cooperation of nations, of groups, because we do believe, as our name is, that we are all interdependent. I know that these days that might be a bit foreign concept in many parts of the world, but we truly believe that we will prevail. We are headquartered in the Philadelphia Fed, and we host about 15 to 20 events a year, both in the US as well as overseas. And the topics are really of a wide range. Of course, like we have today, the central banking, monetary policy, but it also could entail food and water scarcity and the implication that this has on international stability. It touches on digitalization, as we will see also today, on the role of higher education in competitiveness and global productivity, as well as the impact of disabilities on the economy and the workplace. So you can see that we embrace a large number of topics. In 2018, we announced our College of Central Bankers initiative, and this was to further sustain and enhance our relationships with former leaders of world central banks. And in fact, in December, we are going to welcome on our 2019 members of this College of Central Banks in Philadelphia on December 13th. So we invite you to come there and join us to celebrate this. Current members are Christian Noyer from the Bank of France, Anthony Santamero, former president of the Philadelphia Fed, Will Poole, a former president of the St. Louis Fed. So this is, again, an interdependent type of organization. Before I take too much longer, I just want to finally thank our speakers today, taking the time to share with us their views on monetary policy and central banking at a time when the financial markets are really focusing primarily on that, spotlight being on you. So with that, I will invite to the podium my colleague here from BBVA, Mr. Páramo.
So thank you very much for the opportunity to start and perhaps motivate a little bit the discussion that we are about to attend. This conference comes at a great timing. I'm sure that the international context will feature prominently in the discussion that we are about to listen. So the international context these days is dominated by two factors that have prevailed over the last quarters. First is, of course, trade tensions and the escalation of those. And secondly, the actions taken by central banks, partly as a consequence of this. Trade tensions no doubt have escalated. We are still pending of the US-China trade talks to be resumed in the coming days. It is a matter of fact that effective tariffs have been climbing significantly. And the context is already resulting, and we have seen recent indicators, ISM and others, that signal upcoming slow economic growth, mainly due to lower industrial output, fewer exports, and also lower investment. So The possibility of further negative spillovers is there, associated to confidence shocks and financial markets volatility. How is this affecting central banks' policies? Well, we have seen the recent decision of the ECB to relaunch easing measures with a package that I'm sure that Luis de Guindos will touch upon in his intervention. The Fed has just lowered for the second time in this new easing cycle, so Charlie, I think, will deal with this as well. And many other central banks in emerging countries are already starting an easing cycle, and in some cases in a very aggressive way, and I have Turkey in mind, but some others. So in the short term, of course, trade tensions create a supply shock. And monetary policy can only accommodate counteracting in some way. But the question now is, how effective remains monetary policy in the current context of very low rates? And what is the level and quality of growth that we can engineer with current macro policies? If one thinks longer term, in terms of monetary policy in this very complicated context, there is a word that comes to mind that deserves some attention, which is coordination. Coordination, first, among central banks. And I have to say that one of the main lessons that the recent financial crisis has taught us, and Charlie and myself are witnesses to that, because I remember when I attended your conference in Chicago in 2008, and how the negotiations for swap agreements, dollar, euro, and some other things, advice, consultations. So this coordination between central banks, not to speak about the coordinated lowering of interest rates in October 2008, which is a unique event in history. So today, capital flows are more connected than ever. So shocks could rapidly spread, not to speak about the digital revolution and what this implies in terms of cross-border and real-time payments the world over. So, and digital currencies, of course, are in the background to perhaps complicate things a bit more, because we are still defining what the digital currencies should be and whether central banks should involve themselves in the creation of such currencies. So coordination among central banks, coordination or consistency in the instruments that central banks have at their disposal. In the old days, there was the interest rates. These days, we have all kinds of non-conventional measures. And on top of it, we have the new macro-prudential toolkit with which one can complement monetary policy when addressing specific sources of instability. How to deal with those in the current context is a question mark. And finally, coordination between monetary and fiscal policy. And this is a very hot topic these days. I'm of the view that the capacity of monetary policy is not without bounds and could have side effects. In that context, I think one has to remember the fiscal policy has been pro-cyclical in some areas during the past crisis, and it's to be hoped that this will not repeat itself in the current cycle. In Europe, where public sectors are large, monetary policy could be much more efficient, much faster and with fewer side effects if fiscal policies were aligned with it. But we still have in Europe a lack of coordination devices in order to align fiscal policies also at the regional level, and the buffers that are available to do fiscal policy these days are not evenly distributed. So coordination is more important than ever, also taking into account that to be effective, monetary policy should remain independent. And there are discussions out there that put this into that. So with the outstanding panel of speakers that we have with us this morning, I think we will hear very illuminating remarks in order to continue discussion after the meeting. Thank you very much for this opportunity. And Rafael, you have the floor.
Okay, thank you. Good morning. My name is Rafael Repullo. I'm the director of the Center for Monetary and Financial Studies, CEMFI for short, which is a graduate school in economics and finance founded by the Bank of Spain 32 years ago. It is my privilege to chair this panel discussion with two leading central bankers. Charles Evans is president of the Federal Reserve Bank of Chicago since September 2007, so 12 years. He has a PhD in economics from Carnegie Mellon University and has been at the Federal Reserve for almost 30 years. Prior to becoming president, he had a remarkable career at the research department of the bank, publishing some very influential papers in top academic journals. For example, one of his papers entitled Nominal Rigidities and the Dynamic Effects of a Shock to Monetary Policy has over 6,000 citations in Google Scholar. Luis de Guindos is vice president of the European Central Bank since June 2018. At a very young age, he joined one of the elite corps of the Spanish administration, that of state economists, and since then he moved between senior positions in the public and the private financial sector, gaining very valuable experience for an extremely challenging job, namely that of Minister of Economy from 2011 to 2018. In that capacity, he had to deal with the sovereign debt and banking crisis, from which the Spanish economy emerged with one of the best economic performances of the European Union. So we have two very different profiles, currently addressing a very tricky environment for monetary policy. From the tranquil days of the great moderation of the 1990s and the early 2000s, we have moved to a new era of what Larry Summers called secular stagnation, with low real interest rates and very low inflation, which poses a big challenge for achieving the price stability objectives of central banks. Currently, the inflation rate is 1.4% in the US and 0.9% in the Eurozone, and it is not expected to reach the 2% target anytime soon. So as Charles Evans put in a recent speech, this has become, and I quote, a seemingly perennial source of frustration. To address this challenge, central banks have developed a new set of tools such as forward guidance, quantitative easing and tightening, paying or charging interest on excess reserves, long-term refinancing operations, etc. Tools for which they had little analytical background, empirical evidence, or practical experience. To make matters worse, following the global financial crisis, central banks have become key players in the area of banking regulation and supervision, regularly conducting stress tests, adding macroprudential tools to their set of responsibilities, while at the same time monitoring developments in the shadow banking system. As noted by Janet Yellen in 2014, the greater focus on financial stability is probably the largest shift in central bank objectives brought by the crisis. And just to add to this pot, there is a big issue that Jose Manuel mentioned on the coordination among central banks and with fiscal authorities. So life has become much more harder for central bankers, and they must look back at with envy to the great moderation period in which, following more or less a simple Taylor rule, was just about right. Okay, so the organizers of this panel have proposed a number of questions for discussion, and I will open the floor for discussion later. And some of the questions are impact of monetary policy in a low interest rate environment, the next review of monetary policy strategy, interaction between macro, pro, and monetary policies, need for global coordination of monetary policy, and last but not least, the very sexy topic of central bank digital currencies. Obviously, too many things on our plate, but to get started, the speakers will make some introductory remarks. Charlie will do it first, and then Luis. Thank you.
Thank you very much, and it's a great pleasure to be here in Madrid. This has been a very nice trip. The GIC organized a nice conference in Frankfurt with the Bundesbank and here today, so it's very nice. And it's somewhat easy to deliver on a request like this, and I find myself still wanting to thank Jose Manuel for honoring his commitment to come to Chicago in September of 2008, after Lehman Brothers had occurred and when everyone was trying to figure that out. And he came to Chicago to speak and open our international banking conference that was co-sponsored with the ECB. So thank you once again. And Rafael, it's always nice when people are paying attention to your speeches, and so thank you very much. Today, I'd like to make a few comments about the situation in the United States, the economic outlook as I see it, and the adjustment in monetary policy recently. And before I forget, I'd like to say these are my comments only and not those of anyone else in the Federal Reserve System or my colleagues on the Federal Open Market Committee. Well, I would say that in the U.S., the economic outlook is really quite good. See, I'm going to try to figure out how long I'm speaking. Okay, all right. The economic outlook in the U.S. is, the fundamentals are still strong. There have been some unevenness in the data most recently. Let me talk about that. But I'd say the bright spot in the U.S. is the consumer. Consumer spending has been quite strong for quite some time. The consumer has benefited from a vibrant labor market in the United States. Unemployment has fallen to 3.7% nationally. It is being shared quite well everywhere throughout the United States and also across different income groups. Folks have benefited, and so I would say it has brought more low-income, low-skill workers into the workforce to improve their attachment to the workforce, and that potentially has longer-term gains as well for our economy. So that has been quite a positive. I'd say the downside for the U.S. has been on the business spending side. Capital expenditures have been negative at various points. We've heard many reports about businesses being nervous about the trade uncertainty, the trade brinksmanship that's been taking place, the U.S.-China trade negotiations, and other aspects of that. The ISM report just the other day came out, and it sort of confirmed that manufacturing, according to that index, is contracting 2 months below 50, and that seems to be a bit in line with business reports that so many of us have received about capital expenditures spending sort of being on the sidelines waiting for a resolution of uncertainties about trade. Foreign growth is weakened as well, and so in this environment, it's still quite remarkable that my outlook for the U.S. economy is for 2.25% growth in 2019, and I would say a run rate going forward is about 2% for the next 18 months, with growth decelerating to trend, and I put trend at 1.75%. I would say that on the weaker side has been the inflation outlook, that inflation has been underrunning our 2% symmetric objective for quite some time. We had briefly gotten back up to 2% on a core PCE inflation basis, but then we retreated a bit. So it's been quite a challenge, perennially disappointing to find that what we thought was the inflation data moving up with momentum, 2%, finding headwinds and retreating. So in that context, you might be surprised if you haven't been paying attention as much as we do to the U.S. data, that monetary policy in the U.S. has sort of changed directions from 2018 to where we are currently in 2019. So let me talk about that for a little bit. And back in 2018, I would say that there were two distinct lines of focus for monetary policy. One was that foreign growth was very strong in 2017, and the entire world was enjoying a resurgence of growth. In the U.S., there was the expectation of fiscal stimulus and then actual fiscal stimulus with tax cuts and corporate tax reform in the United States. The architects of this fiscal expansion allowed themselves to increase the national debt by $1.5 trillion over a 10-year basis in order to pass the legislation. And then on top of that, Congress and the President agreed to increase federal spending as well, and so that increased stimulus by a few $100 billion as well. In an environment with business deregulation, which had been expected for some time under the new administration and actually being put into place, and the tax cuts, it looked as if aggregate demand was very strong, that the U.S. economy continued to be growing above trend. Unemployment was falling below most estimates of the sustainable level of unemployment, and inflation looked like it was going to move up to 2%. So in this context, it made sense to most central bankers that the Fed should move to remove the very large amount of accommodation that had been in place for some time, with interest rates rising from zero slowly, and move up at least towards a neutral rate, if not beyond the neutral rate. And so the question is, we should gradually remove accommodation, and how far should we go? Should it move towards a restrictive setting? That was the thinking in 2018. At the same time, another line of focus is that inflation pressures seem to be moving up to 2%. It looked like they were moving up with momentum. And a question that continued to bother me was whether or not it would be sustainable. It would be sustainable at 2%, and we'd go forward. We have as our inflation objective that it's a 2% symmetric objective, and so we should spend time above 2% as well as below 2% and hopefully average 2%. And so, in my opinion, it made sense that we should strive to overshoot inflation a little bit, and the undershooting of the unemployment rate below a sustainable level could help support that as well. But it turned out that there were some bothersome developments in the inflation data, some relative price changes that found their way into softening inflation data, telecommunications pricing of internet data capability changed things a fair amount, and it was unclear how much that was going to reduce inflationary pressures, and it called into question how restrictive policy should be. And so in that context, my own thinking on monetary policy was we should strive for some monetary policy setting ultimately at the end of the rate cycle of something that's just a little bit restrictive, say 50 basis points above my assessment of a neutral rate, which is not very restrictive. If we had been able to pull that off, that would have been about the least restrictive monetary policy at the peak of an economic cycle that I can remember in the post-war period. So I thought that that could be enough. Going into the December 2018 FOMC meeting, I brought that thinking, and I thought that we would increase rates by 1/4 point, as we had done 3 times already that year, and fundamentals continued to be strong. But the economic risks seemed to be increasing. There was more uncertainty associated with trade discussion. The tax bill that was supposed to, the architects of the tax bill had indicated that they expected business investment to be increasing quite substantially. That was one of the benefits, and it was really tough to see that on business fixed investment. Trade negotiations were dampening the appetite to expand capacity, and foreign growth was weakening as well. On top of that, there was financial volatility in the fall of 2018, and critics of the Fed referred to our reduction of the balance sheet over a slow period of time as quantitative tightening, which I didn't exactly subscribe to myself. I thought it was a rebalancing, but at any rate, there were many critics who were kind of questioning whether or not we should be as restrictive as that. So the December FOMC meeting raised the funds rate by 25 basis points and continued the balance sheet decline. And then the data began to soften a little bit more in the economic data. And so the committee took a pause beginning in January, looked at the data. We indicated at every opportunity that we were data dependent, went through the spring, and we did not increase rates at that point. And it did seem to be a concern that inflation was not staying up at 2%. So that was sort of the environment that took us into June of 2019, when all of a sudden the Fed decided to cut interest rates 25 basis points, and then in the July meeting, and then in September another 25 basis points. And so I've referred, Chair Powell has referred to this as a mid-cycle adjustment, one where all of a sudden, because of the headwinds that we were facing, it seemed appropriate to strive for a monetary policy setting that was slightly accommodative, I would say 50 basis points below a neutral setting, as opposed to what I'd previously thought of as 50 basis points above that. Now, I do think that this entire adjustment could have been justified on the basis of the weaker inflation data. That is, I am concerned about risk management, that there are headwinds that the U.S. economy is facing. The ISM data is one example of that in manufacturing. But it's also the case that because inflation has persistently underrun our 2% inflation objective, that we ought to just absolutely make sure that we get to 2% and beyond. And so I could easily have argued and would have supported cutting the funds rate on the basis of just pointing to inflationary pressures. I think that would have better guaranteed that inflation could have been rising to 2%, as well as provide more risk resilience. I think when we're focusing on a symmetric inflation objective of 2%, this is a term that few central banks use, and I think that we've all sort of struggled to explain this. In our long-run strategy, we basically say it's symmetric. We indicate that the committee would be concerned, could be concerned if inflation persistently stayed below 2% or above 2%, but we don't really describe the path or any type of adjustments for underrunning or for overrunning. And so I think that any additional descriptions of symmetry would be welcome. In this context, I think it's important to actually overshoot inflation and go above 2%. So I think our current risk positioning is good for the current setting of the U.S. economy. Like I say, I'm looking for 2% growth, but there are downside risks. I think that adjusting policy by 50 or 75 basis points helps businesses and consumers and employers if things soften a little bit. I would say that if there's a more nonlinear response, if there's an event that shocks the world economy or the U.S. economy, these modest adjustments aren't going to have been nearly enough. This is very much just risk management to help make things work out better as we strive to bring in growth at about 2% over the next 18 months. And so I think that's been helpful. I think that's a good setting for the U.S. policy. I think I'll stop at that point and entertain questions from the moderator and also everyone else.
Okay,
Thank you
Charles,
very much.
thanks. Luis, the floor is yours.
Buenos días a todos. Muchísimas gracias a la Fundación, a los organizadores. Estar aquí en Madrid rodeado de tantos amigos en tan buena compañía. Aunque se me va a hacer un poco extraño, voy a continuar en inglés, si me permiten ustedes. A decade after the global financial crisis, the level of economic activity in the euro area remains disappointingly low. It took 9 years for real per capita GDP to surpass its pre-crisis level. Likewise, euro area inflation has stubbornly remained below the ECB's aim for much of the past decade. Throughout this period, the ECB has acted decisively to support euro area demand and lift inflation on a sustainable path towards our aim of below but close to 2%. This includes lowering key ECB rates to record low levels and adopting a wide range of non-standard monetary policy measures. Internal estimates point to a significant contribution of monetary policy to euro area GDP and inflation. By contrast, the contribution from fiscal policy to macroeconomic stabilization in the post-crisis period has been, at best, muted. During the period 2010-2012, economies representing around a third of euro area GDP carried out procyclical fiscal tightening to restore confidence in their public debt. Since then, fiscal policy has been broadly neutral. In our most recent meeting, the Governing Council responded to the continued shortfall of inflation with respect to our aim. Recent economic data have pointed to a more protracted weakness in the euro area economy. Prominent downside risks remain and inflationary pressures are muted. We introduced a package of measures designed to support the euro area expansion, the ongoing build-up of domestic price pressures, and thus the sustained convergence of inflation to our medium-term objective. The Governing Council also noted the need for countries with fiscal space to act in a timely and effective manner, and for all countries to reinforce their efforts to achieve a more growth-friendly composition of public finances. In my remarks today, I will focus on the respective roles of monetary and fiscal policy in supporting macroeconomic stabilization in the euro area. In particular, I will set out why the current juncture is particularly appropriate for fiscal stimulus. I will also offer some thoughts on how to improve the current framework. The literature on optimal currency areas points to the need to counter two types of shocks: those that are common to all countries and asymmetric ones that affect a subset of members. For common shocks, monetary policy can act to stabilize the economy. For idiosyncratic shocks, stabilization becomes trickier. Monetary policy cannot target individual countries, and those affected have lost the ability to adjust the exchange rate to help cushion the effects of the shock. For asymmetric shocks, stabilization comes ex ante from greater cross-border risk sharing to improve resilience and exposed from fiscal policy. But it is worth revisiting this classic dichotomy of using monetary policy for common shocks and fiscal for asymmetric shocks in the light of recent experiences. Fiscal policy at a national level in the euro area was unable to fully counter asymmetric shocks during the crisis. And at aggregate level, stabilization may benefit from both monetary and fiscal policy working in tandem given the current environment of low interest rates. Nominal interest rates have been declining in advanced economies since the 1980s. In large part, this decline is attributable to the decline in average inflation over that period of time. Investors require lower compensation for expected future inflation, and the fall in inflation volatility over the period has also reduced the inflation risk premium. The decline is also a result of a secular fall in the natural rate of interest, which is the rate that balances desired saving and investment in the economy. While the natural rate cannot be precisely measured, as you know, a range of estimates point to its decline. There are a number of contributing factors to the decline, principal among which is lower potential growth. Lower potential growth reduces the expected rate of return on capital, so reduces the rate at which firms are prepared to borrow to invest. Other factors that are believed to have further weight on the natural rate include the aging population in Europe, which is estimated to have reduced the natural rate by 1 percentage point over recent decades. The role of income distribution and rising saving in emerging markets and a general rise in risk aversion. This fall in the natural rate has important implications for the optimal policy mix in the euro area. The interest rate at which point monetary policy becomes accommodative falls directly in line with the natural rate, so the effective lower bound on nominal rates has become a much greater consideration in the setting of policy. Before the crisis, it was estimated that interest rates in the euro area would be likely to hit zero only once every 50 years. At the current natural rate, rates at zero or below are likely to be a much more frequent occurrence. As the experience of the past decade has shown, the decline in the natural rate is not an impediment to monetary policy providing accommodation to the economy. But it does mean that monetary policy has to remain accommodative for longer, with greater recourse to unconventional measures. Those factors carry with them a greater risk of undesired side effects. In such a situation, economic theory tells us that fiscal policy should play a much more substantive role than usual for business cycle stabilization. The reason is straightforward. In normal times, when output is close to potential and inflation is close to its objective, a fiscal expansion threatens to push inflation above the central bank aim. Central banks normally respond by raising their policy rates, and the increase in interest rates partially crowds out private sector demand. However, when the economy operates below potential, the central bank has no reason to fight a fiscal expansion. Policy rates would not increase, and private sector demand would be crowded in, leading to a much larger positive effect on aggregate demand and inflation. In other words, when policy rates are close to the lower bound, fiscal policy becomes more effective in stimulating aggregate demand. Moreover, while monetary policy must take the natural rate of interest as given, enacting the right fiscal policy can help raise it, in turn making monetary policy more powerful. Policies to encourage labor force participation, particularly of older workers, can help raise rates. Increasing spending on education and public investment can help productivity and lift both potential growth and private investment. Furthermore, any policy implies trade-offs. Side effects of very accommodative monetary policy may become unduly tangible when the economy operates below potential for a long time. In fact, while we believe that benefits overall outweigh costs, we acknowledged the challenges that a sustained low interest rate environment poses for banks. So there is a role for fiscal policy at present to help counter common shocks at the European level. To the extent that member states have created fiscal space, It would therefore be desirable for fiscal policy in the euro area to more actively support business cycle stabilization. Currently, the fiscal stance is assessed to be only mildly expansionary at the aggregate level. But the current institutional framework is insufficient to deliver that required stimulus. Fiscal policy remains a national responsibility in EMU, with some common rules applicable to individual countries. In its first incarnation, the Stability and Growth Pact focused almost exclusively on fiscal sustainability, with little emphasis on fiscal stabilization. In recent years, the Stability and Growth Pact has undergone several reforms, some of them with the explicit aim to provide a more prominent role to stabilization considerations, both at the country level and at the euro area level. The result has been rules which are now viewed as complex and opaque, with little evidence that they have delivered a more countercyclical fiscal policy stance in the euro area. The Stability and Growth Pact has limited flexibility and does not lend itself to incorporate area-wide stabilization elements. National-based fiscal rules, with the focus on domestic issues, tend to neglect positive cross-border spillovers. They fail to recognize the benefit of cross-country risk sharing and the vital role played by the public sector in underpinning it. In other words, rules based purely at a national level, or even rules that coordinate the fiscal stance across countries, are not enough by themselves. Empirical evidence suggests that the spillovers from a fiscal expansion in the euro area countries to others are positive but small. So while it is important for those countries with available fiscal space to use it domestically to support overall stabilization, a central fiscal capacity with the ability to allocate expenditure across countries is much more powerful. A dedicated centralized fiscal capacity could not interfere with domestic policy, but act as an overlay to it. By focusing on common area-wide stabilization, it should not affect national fiscal space. This focus would also help to ensure that these areas of expenditure that are vital for long-run growth are not cut during any downturn, helping to preserve future fiscal space and support long-term real interest rates. Such a central fiscal capacity would clearly need to be carefully designed to mitigate any risk of moral hazard. But the essential features are that it should have sufficient firepower to effectively contribute to macroeconomic stabilization. It needs to be sizable and agile enough to react rapidly to emerging threats. But macroeconomic stabilization in the euro area can only function properly when other EMU features and institutions are adequately designed and operational. First, banking union needs to be completed. Unified banking supervision and the Single Resolution Fund have provided greater confidence that banks operating in the euro area countries face the same conditions as in their home markets. But the banking union remains incomplete as long as there is no common deposit insurance scheme, and the fiscal backstop for the Single Resolution Fund is too small. There is a political agreement about and terms of reference for the Single Resolution Fund backstop to be provided by the European Stability Mechanism, but not yet about the European Deposit Insurance Schemes, what we call EDIS. Second, it is imperative to accelerate progress on the Capital Markets Union. This is ambitious. It entails the streamlining of core aspects of national policies, such as taxation and insolvency regimes, essential to integrate legal underpinnings of cross-border markets. Capital markets can smooth country-specific shocks by providing a larger pool of financial assets that can be shared cross-border. This helps to decouple wealth and income, and hence consumption from output. Let me conclude. The euro area risk outlook is again tilted to the downside. This is a conjunctural concern, and monetary policy has reacted in accordance with its price stability mandate. The global decline in the natural rate of interest over the past quarter of a century, however, poses structural challenges. Policy rates will likely remain low by historical standards and may hit their lower bounds more frequently than in the past. We have learned from the experience in Japan that it is possible to get caught in a vicious cycle of declining inflation expectations, falling inflation, and a binding lower bound on nominal interest rates from which, when in full motion, it is difficult to escape. It is thus of the utmost importance to enhance the firepower of euro area stabilization policy by means of a policy mix that, while continuing to make full use of monetary policy, assigns a much more substantive role to fiscal stabilization policies. I firmly believe that the institutional foundations for a European fiscal capacity would be an important step in that direction. Thank you very much.
Okay, well, thank you, Charles and Luis. We have a bit less of an hour for the discussion, so I think that there is ample time for us, including the audience, to address questions to the speakers. But let me start with a couple of questions for them, just to get started. President Evans has made a reference to the size of the Fed's balance sheet. And I want to ask something related to that balance sheet, and it's connected with the issue of the doom. Is cash doomed? There is a widespread view among many people that cash has its days numbered. In fact, in countries such as Sweden, cash is rapidly disappearing as a means of payments, and in other countries, different forms of digital currencies are going to appear. But this view contrasts with the reality of what has happened with currency in circulation in the Eurozone and the US. Eric Rosengren, the president of the Boston Fed, in a speech earlier this year, noted that in the last 15 years, the currency in circulation in the US has more than doubled. Actually, it's like 2.5 times what it was in 2004, representing now 42% of the greatly expanded size of the balance sheet of the Federal Reserve System. In other words, a lot of the QE that we have seen is a counterparty of the higher demand for cash. One may think that this may be the result of the international role of the dollar in legal and maybe illegal transactions, but the experience of the Eurozone is not much different. In the last 15 years, the banknotes in the balance sheet of the Euro systems have almost trebled, representing now 26% of the balance sheet of the Euro system. So the question is, why so much cash? What is it? Do you know?
It's a hard question. It's certainly been the case that, as you say, people have been forecasting the demise of cash usage in the U.S. for quite some time. We have quite a large number of cash vault operations in the U.S., and we've tried to right-size, our footprint with that. But as you, take that striving for efficiency against what the demand is, the demand continues to increase in certain types of areas. Cash offers a number of services. One is anonymity, so people enjoy that. It's not always for the best purposes. It could be for nefarious activities or tax avoidance or things like that, but nevertheless, it is traditional. I think that the expectation that digital services will supplant cash has an underlying assumption that everyone in the economy has access to banking services in the same way that I do or whatnot. And there is just a large number of people who don't have a bank account in the U.S., which is somewhat surprising. There's a large number of people who can't make an emergency $400 expenditure when they need it to fix their car or something like that. So there are a whole bunch of things that they are juggling, and using a bank account in an efficient way is sometimes much more challenging than just having sufficient income to make your payments and fit your needs. And so I think we're just going to have to see how this evolves. I continue to be amazed that phones are used by so many people, many of the ones who I just described who might not have a bank account, they have a phone. And so there are a lot of uses that need to be understood better than I have them. We do have experts who are looking into this, and they have some expectation along the lines of what you're suggesting, but my own guess is it'll be drawn out for quite some time.
So as Charlie has said, this is a hard question, but I think that it's quite a pervasive, phenomenon, in the sense that it's happening not only in the States as well as Europe. And I think that, you could say that it has to do with the level of low interest rates. While hoarding becomes, more attractive. But I think that this fact started before the low level of interest rates era that we are having now. No? So it's something that we have to analyze much more in detail. But we have to try to find out what are the incentives behind the behavior of people. No? And but in the meantime, for sure that we will continue delivering and supplying cash.
Well, that, I guess, is very good for senior age as long as interest rates remain positive. Okay, let me go for a second question, which is related to a seminar that I attended yesterday about the way in which pricing algorithms based on artificial intelligence are supplanting human decision makers in firms and markets. Off-the-shelf pricing or repricing software is readily available online, and apparently there are many startups in Tel Aviv basically producing this kind of software. So one would expect that the trend towards using algorithmic pricing will continue and accelerate. Now this means that, if I understand correctly, the implications of this event, that prices will become more and more flexible. So what do we do with standard framework of monetary policy that relies on price rigidities to go from nominal interest rates set by central banks to real rates that presumably are the ones that influence agents' decisions?
Sure. It is an exciting area of research. I haven't paid close attention to it. It has many different strands, which are areas that are not, my specialty. Many of the strategic pricing, game theoretic aspects of how you make adjustments to your pricing, auction pricing, details, things like that. Just casual conversations with my wife about when she should be booking her airline ticket to go visit her mother, and she tells me, well, the flight to Atlanta was $250 on a Saturday when she tried to look at it for next week, and I think if I wait till Tuesday, it might go down. Sometimes it goes down, sometimes it goes up. Somebody has algorithms that are trying to, one way or another, extract consumer surplus, from consumers who otherwise might be able to enjoy lower prices. Now, that's always up for grabs, in an economic standpoint. I don't know there is no efficient way to carve this up, and so it's part of the business model. Now, as somebody who has, I suppose the point of your question is, my research indicates that I have a slight vested interest in arguing that sticky prices might be important for how monetary policy plays out, as well as sticky wages too, probably more important on that basis. And I can't say I know exactly how this would play out. I'm going to conjecture that, businesses probably have sort of an average level of prices that they're striving for, and they're trying to get a little more of the consumer surplus for their own, but I'm not quite sure how much they move it up or down. Price stickiness, menu cost isn't the right way to think about it, but planning cost, and when they try to take it to a different level, that might involve some time aspect that still would give a role for monetary policy. But that's pure conjecture. It's a fascinating area of research.
I guess you mentioned sticky wages, and that's probably something that is here to stay. So that's...
Yeah, I think so.
Luis, you want to add something to this?
Well, I think that we should turn rapidly to the audience because you are posing very interesting questions, but very difficult ones. So, well, I think that perhaps, the point of, I think that is much more relevant in my view, with respect to the recent evolution of inflation in the euro area, is the sort of decoupling that is happening between wage inflation and price inflation, headline inflation. And this is something that is a surprise for us. It's something that we have paid a lot of attention and a lot of research, because it's obvious. If you look at the evolution of wages in the euro area, well, wage growth is something close to 2.5%. Whereas inflation, as you have said before, is 1%, and core inflation is almost flat, around 1%. And this is something that is new for us, because normally the pass-through has to happen. Why has not happened so far in the euro area? Well, there are a lot of explanations, about that. Perhaps it has to do with the digital economy. that a much more volume, a higher volume of trades take place online, as Charlie has said. Even in the case of the ECB, we are analyzing, price behavior in internet in order to understand much better, the dynamics that this could have for the broad headline inflation. And perhaps, there is something that is new. Perhaps, we have living in a period of time of very low inflation with very low volatility in the headline inflation rate, and that has limited, the possibilities of corporates in order to pass through. Or perhaps, there is another explanation, is that, corporates are defending much more market share than trying to, let's say, maximize in the short term, revenues. So I think that this is an area of interest, for sure, that is very relevant, as you have said, for central banks. I think that we need to understand much better, the behavior of price dynamics in the digital world. I heard that, there was a definition of this algorithmic pricing that you have said. An algorithm is a judgment with numbers. So we will have to, we are entering into a new era. This is something that, I think that is going to be extremely relevant. Because, inflation is, in the case of the ECB, the single aim of our mandate.
Okay, well, thank you. I think that it is time to open the floor for discussion. I have some more questions here, Luis, if in case you want me to. But I think that I think this is time for listening. Can you please make short questions so that many people can? So let's start with José Luis over there.
Well, thank you very much to the two talkers. They have enlightened us. Now I have the questions for both of them. This question is about the risks of the current ECB monetary policy. I would like to know their views on two major risks of the ECB monetary policy. One risk is that it may be counterproductive, that is to say, it may be lowering inflation and GDP rather than the other way around. Below the zero lower bound on interest rate is reached, there is another bound at which the interest rate elasticity of savings turn out to be negative in rich and rapidly aging societies. The income effects of interest rate changes on savings may predominate over the substitution effect. Now, the other risk is that it may be inflating bubbles. On bubbles, we know that we should not confuse the absence of evidence with the evidence of absence, but in this case, there is a clear bubble inflating before our eyes, which is the price of a very important financial asset, the price of banks. The price of banks is well below the book value. This means that the return on the capital of banks is well below the cost of capital of banks. This is a very dangerous situation. This situation cannot be corrected by merging or translating the negative interest rate cost to customer, and it prevents the raising of capital to comply with the regulatory requirements. At the end of the day, it prevents lending, and obviously some banks may save the day, but there is always the risk that in some corner of the system, something may happen. Well, these are the two major risks of the ECB monetary policy, in my view, and I would very much like to know the views of both Mr. Evans and Mr. Guindos on these risks. Thank you.
I guess that, Luis, this is for you.
Well, I think that the question of the side effects is something that is quite relevant. I have, we are paying a lot of attention to that. There is even non-linearity, in the effects of, these non-conventional monetary policy measures. This is something that we have to recognize. So far, our view is that the very accommodative monetary policy has been very positive for the recovery in Europe. It has pushed, and I suppose that afterwards Massimo Rostagno will develop that much more and will elaborate on that. Our monetary policy stance has made a great contribution, an important contribution, perhaps the only contribution to the recovery in Europe. But we have acknowledged several times that side effects are important. And there is one that you have referred, because I will focus on the question of low profitability of banks, low valuations, price to book below 1, these kind of things that I think that is quite relevant. That's a reality in Europe. If you look at the valuation of banks and equity prices in Europe, they are clearly below 1. It's not the case of the States. In the States, it's above 1. And I think that it has to do with what you have said. The return on equity is clearly below the cost of capital. Why? Here you have two explanations. The first one is to blame, monetary policy. It's the low interest rate environment of that monetary policy has put in place in the last years. Well, this is one explanation, and for sure that is having an impact. But our view is that besides low interest rates, there are other explanations that really are important in order to understand why valuations of the banks are so low. The first one is when you look at for instance the structure of costs of the European banks. The second is, for instance, if you look at the excess capacity in the banking industry in Europe. For instance, the cost to revenue of the European banks is clearly above the US average. The third one is, the outlook. Potential growth in Europe is clearly below potential growth in the case of the States. So all these elements, I think that there are much more structural reasons behind the low valuation, but I do not deny that the low interest rate environment, is having an impact on the valuation of the banks. But structural elements are much more important and much more relevant. But if you want my opinion, I think that the low environment, if you look at our assessment of financial risks in the financial system in Europe. The low profitability of banks is a problem. It's a problem because in terms of valuations, it makes almost impossible to carry out a capital increase in Europe. And simultaneously, if you look at the shrinking margins, net interest margins of the banks, it's going to be extremely difficult even to generate capital organically. And even there is something that we have not explored so much, but I think that is something that we have to take into consideration, is that perhaps these low valuations are a clear impediment for consolidation in Europe. That is something that is needed. Why? Because if in a takeover operation you have to raise capital with such low valuations, it makes it very difficult to carry out a right issue, and then the operation is rejected by the bank. But we cannot overlook the real reason behind this low valuation. I think that sometimes, for the banks and for the management of the banks, it's easy to say, it's a low interest rate environment. But I think that there are other causes that are much more relevant in order to understand this low valuation and the low profitability of banks.
Charlie, I guess that this is not so relevant for the U.S. now, maybe more in the future.
But the question touches on an issue that comes up over and over again in different disguises, and that's why are interest rates so low? Low interest rate environment is challenging banks in different sectors. Savers would like to enjoy a higher rate of interest, and I think that it's just very important that we sort of understand that there has been a long secular decline in nominal interest rates, long-term nominal interest rates, and this is because of a variety of reasons. Economic fundamentals are such that trend growth is now much lower than it was 10, 20, 30 years ago when interest rates were higher. So the real component that investors can enjoy is going to be lower average equity rates are going to be lower. Capital returns are going to be lower, and borrowing is similarly affected. And it's also the case that inflation, central banks have been successful in bringing high rates of inflation down towards their targets, and our targets are low and stable inflation, and we've been underrunning that, and so nominal interest rates will continue to reflect lower rates because of that. And it's just not, and I hear this quite often. I hear this from my wife. She would like to have a higher rate of savings. Her little savings accounts aren't earning very much. If for some reason we tried to engineer an untimely increase in nominal interest rates, this would not be good for the economy, even if it were better for some financial players. My wife didn't really enjoy a higher rate of savings on her, on her savings accounts at banks because they weren't passed along to the retail level, and so there's that issue as well. But if we tried to engineer a untimely increase in interest rates, I'm pretty confident that the economy would suffer because of it, and then we'd end up back at the zero lower bound more quickly and further behind than we were. And so I think that it's important. The suggestions that Louise made about the appropriate fiscal policy aiding the challenges that central banks have had to take on in greater measure because fiscal space has not been available or taken up, I think are very important for that. But we just need to be mindful of all of that.
Well, the third row here. Please identify yourself before asking the question. Yes, here. Please.
Thank you very much for the presentation. My name is Enrique de Areva. I want to make just two questions, one for each one of the speakers. For Mr. de Guindos, is, can I say, with the current scenario, what we are pretty close to open the door for a new crisis, Draghi's strategy is the best way to support the new years that we're going to be in some kind of, say, difficulties in terms of the financial situation. And for Mr. Evans, based on your presentation, can we think that we can set like a target how can I say this, the rates for the inflation rates, like targets in the companies, in the governments, could be can I say a tool to control the demand and the prices and setting the level of the inflation rate in a target way.
I'm sorry, I'm not sure I understood that. Maybe I didn't hear you correctly.
So I can say that with the current scenario, we have very low inflation rates, which means is making a bad effect in some kinds of the situation of the demand, the situation of the prices, even to control or to manipulate to set the inflation rates.
Okay, Charlie, you go first.
Well, my background is as a monetary economist, and sort of a classical viewpoint is that it's the central bank that is completely responsible for the rate of inflation. And when the inflation rate is 8 or 10%, like it was in the 70s, and in the U.S. when Arthur Burns went on. He would give some descriptions about the current situation. Inflation was too high, and the Fed was trying to do something. But it can't be handled. We can't really bring it down. There wasn't enough courage to deal with that. That wasn't really appropriate. Paul Volcker came in and undertook unpopular monetary policies in order to break the back of double-digit inflation, and that was appropriate because the central bank's in charge of that. I think when the inflation rate is below our objective, that central bank is also responsible for that, and so we just need to undertake actions that will support the economy. I think that when you support the economy, I do believe that when we put more strains on resource pressures, that should give rise to businesses passing along costs. We've been challenged in actually seeing that in the U.S. That relationship, the Phillips curve, is much flatter than it was in the 70s when we had volatile monetary policies and inflation, and so the stability in inflation seems to have flattened out the Phillips curve, but it's that inflation expectation that is the other side of this. Even with a flat Phillips curve, we need to convince the public that we are going to deliver on inflation and do what it takes in order to get that up. Now, relative to some sectors and how this plays out, it could have a distorting effect. I certainly take that, but at the overall level, I tend to continue to believe that it's that aggregate demand that's very important for keeping it up.
Well, with respect, I will say, well, first of all, I am not, at risk of disclosing any insights about the discussions of the Governing Council, because we have seen lately that, these discussions have become very transparent. Having said that, there is something that I think that is it is important. The Governing Council of the ECB is a collegial forum. And normally, with respect, there are decisions, many of them, the majority of them, that are taken, with unanimity. And, that's the majority of these are the majority of the decisions. And there are others that we have debate, and debate is something that is normal, especially because afterwards you are going to take policy decisions and to make policy decisions. But once a decision has been taken, one of the characteristics of a collegial institution is that you have to endorse it. So always there are nuances. There are, different views, but once, a decision has been taken in a collegial institution, well, you have to endorse it. Having said that, what are, our decision-making process and the monetary policy decisions that we took 2 weeks ago? First of all, they were based on the outlook. And there is something that perhaps, people have missed a little bit, is that, we reviewed downwards our projections for growth and for inflation, but there was something that it was especially relevant in my view that perhaps, people didn't pay much attention, is that we said very clearly that risks are tilted to the downside. And we referred mainly to 2 kinds of risks. The first one was trade tension, that is beyond our capacity to influence. And the second one is Brexit. And, you have seen that our outlook is that the growth rate in the baseline scenario is a growth rate that is going to be slightly above 1%. But we are not taking into consideration this baseline scenario, and this is something that we have made explicit, the possibility of a no-deal Brexit. Well, the probability of a no-deal Brexit and, how markets discount this no-deal Brexit, it had, ups and downs, as you know. But my impression is that now markets are really underpricing the possibility of a no-deal Brexit. So, having said that, this is something important with respect to the outlook, no? That, despite the fact that we have downgraded our outlook, outlook for growth and for inflation, this baseline scenario doesn't pick up, a very short-term risk that is the possibility of Brexit that could have an impact that is going to be for sure much more moderate than the impact that could have, in the UK economy, but that it would be non-negligible for the euro area in terms of growth. Having said that, what our monetary policy decisions, were built around, one very important element, that is forward guidance. What we said is forward guidance, that we are not going to increase rates until the inflation outlook converges towards our aim. And the rest of the measures are around that, the reduction of interest rates, tiering, to restart and the resumption of the APP program, are built around that. Having said that, I try to convey a message that I think that is important. I think that in life is very, very important to be humble, and humility is a great virtue, if you allow me to say. central banks are not almighty. We cannot address all the problems of the world. Mainly because, well, you know, Brexit. You know, Brexit is something that has nothing to do with monetary policy. It's going to have, you know, implications in terms of growth, in terms of inflation, in terms of financial stability. But well, we can deliver liquidity, and for sure that would smooth, you know, the potential impact of, you know, a no-deal Brexit or a disorderly Brexit. But we are not almighty. We cannot address all the problems of the world. So that's one point. And the second point is that there are other actors in economic policy, you know, implementation. Structural reforms, fiscal policy, completing EMU, in the case of the euro area. And these are important actions that have to be taken. So I think that, you know, both messages are, you know, if you allow me to say, very closely related. Because if we are humble, if we believe that we are not the saviors of the world, you know, then, you know, there are other people who have to jump in and to start to take decisions in other areas of economic policy.
Okay, thank you. I mean, there are many people that want to ask questions, so wow. Wow, so I don't know. Okay, well, you were one of the first, so remember to say your name.
Yeah, Antonio Merino, Chief Economist, Repsol. Thank you to the speaker for their intervention and to the moderator for each remarks and for giving me the floor. I have two questions that I'm always thinking are relevant for monetary policy. First, in the case of the US, what we are seeing is that the downgrade of economic growth expectation is linked to manufacturing, to trade. So I have two potential readings. One reading is, okay, if capital goods and manufacturing goods are affected, why we should not include in the CPI some measure of these goods? Because what we should address is output gap volatility, so things are coming down because of investment or because trade war. So to what extent your monetary policy, when you take into account those goods, is still, I wouldn't say, not enough expansionary? Or the reading could be, we have trade war, this is going to become structural, so the potential growth of the US it's been affected because now we are going to be less globalizers. So to what extent, in this case, your monetary policy is too expansionary because GDP growth potential has come down? That's one question. In the case of Europe, at the beginning, people thought, okay, there is a slowing down of the European economy, but this was mainly and only in Germany. And people thought this is linked to trade war. Well, at the beginning, what I'm saying at the beginning, it was like in the month of March. It began in January with the Volkswagen crisis, then investment in the car industry came down, then sales in Europe came down. So my question is, the shock that we are seeing in Europe began potentially, we can agree, in Germany. And it was linked 80% not to the trade war, but to the regulation and to the uncertainties for consumer about, shall I buy a car? What I'm saying this, because when you look now at the numbers in Spain for consumption, people think, oh, savings are going up. No, it's penta consumption. People want to buy a car, but they cannot buy a car because why the hell are you going to buy a car? It's not going to be allowed to be driven in 2 or 3 years. I mean, and coming down. So my question to Luis is, to what extent there's something in the supply side or regulation side which change how you read the state of the economy and then the reaction function of the ECB? To what extent, if what's going on in terms of consumption and investment going down is more linked to uncertainties from the supply side? Thanks.
So Luis, you go first.
Well, you have referred to a very concrete piece of regulation that is, you know, diesel emissions and these kind of things. But I think that it had an impact, but it's not the main cause. I think that is different. I think that perhaps, you know, the main factor behind the deceleration of the European economy that we are, let's say, overlooking partially is Brexit. You know, the UK is a large economy. It's the second largest in Europe. And, you know, it's totally right what you have said. We have a sort of two-tier economy in Europe. On the one side, you know, manufacturing and exports are, you know, really clearly underperforming the rest of the economy. And mainly, you know, the economies that are much more open and much more exposed to trade, you know, they have been suffering much more. That's the case of Germany, as well as, you know, Italy also, you know, the growth rate of Italy is very, 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 very low. But I think that, you know, besides regulation, and I think that there are a lot of impediments in the, you know, in the real economy in the euro area that we should look at. You know, it's a question of structural reform, not only about fiscal policy. Fiscal policy is important. I think that is much more important, even the quality of fiscal policy, than, you know, the concrete, you know, balances and the stance of fiscal policy. But, you know, for instance, completing EMU in terms of banking union, capital market union, could be extremely beneficial, would be extremely positive for the European economy. But I think that, you know, I think that we have not gauged so far the impact that Brexit is having in continental Europe. That's why, you know, I pay a lot of attention to, you know, the approach of the markets. Markets overreact, as you know perfectly, and depending on you know, the concrete political situation in the UK, they increase the probability of well, you have to look at the bookies in the UK, you know, from 40% to 10%, you know, almost, you know, after a very short period of time, no? So they are volatile, you know, but I think that, you know, Brexit, I think that we are really underestimating the impact of the present uncertainty. And that's why, you know, I have fears and I have concerns that in case of a disorderly Brexit, you know, the impact will be much higher than the one that we are discounting now.
Charlie, at least you don't have to worry about Brexit.
You know, knock-on effects and all of that, but sure. You know, on the question about price indexes and the components of it, you know, it's not an area I ever really cared to study very hard in graduate school, and every time when it comes up, I feel like I should have worked harder on it. You know, there are a number of different elements in any price index. It's traditional to sort of use a consumer basket, a cost of living basket. I think manufacturing, trade, prices find their way into final goods that consumers buy in various ways. Certainly we've seen import prices move around on the basis of risks and also relative currency valuations. And so they find their way into the indexes. We could, you know, spend quite a lot of time, you know, choosing one over the other. I usually sort of end any discussion of that with just sort of the, you know, at some point, whether or not prices are sort of getting out of hand in a way that I don't think that somebody might think they're not being measured, and I think they are, or the other way around. I kind of look to treasury markets and fixed income investors, because there's a tremendous amount of resources and wealth that is at stake and at risk if inflation moves up unexpectedly and they're not compensated for it. So by looking at fixed income rates and seeing compensation for inflation is really low, if they weren't getting compensated, I think it would find its way in higher rates of interest that we just don't see. So I take some comfort in that, but it's always an interesting question. And it's even more difficult because of digitization and everything that's taking place in Raphael's seminar, which probably we all should have attended the other day.
Let's move to the other part of the room. The person at the back there.
Good morning. American question. Carlos Montaña from Mains News. Address the question to Mr. Evans. Market participants will be carefully scrutinizing today's ISM non-manufacturing index for any signs that the other shoe is dropping. So what I would like to know is, you earlier mentioned that the US consumers are still looking strong. You said that in Frankfurt and here today as well. So what are some specific economic data points that you will be focused on between now and the FOMC meeting to gauge whether the assessment of the US consumers is still valid? Thank you.
Well, I talked about that a good bit during the presentation, so I don't want to belabor that. I would say that, you know, the labor market data has been very important and strong for consumers. Income has been increasing on the basis of increased workers coming into the economy. Wages have been going up somewhat. Might have hoped for stronger wage growth, supporting even stronger consumer spending, but they have been strong. So we're going to be looking at, I will be looking at the labor data that come out on Friday and other indicators, and I talked to a lot of business people, and I've got a board of directors that will report to me on how they see things too. So, you know, we pay attention to all the data.
Yes.
Hello, this is Mikel Arreina from the University of Deusto, and I have understood that central banks are not almighty and they cannot cover all the problems of the world, but about the climate crisis and the transition to a greener economy. Since the famous speech of Mark Carney about the tragedy of the horizon and the network of central banks for greening the financial system, what has been done? What can be done on the side of central banks in terms of a green quantitative easing, in terms of penalizing banks that have a brown balance sheet, or just rewarding those that are committed to the change? Thank you.
This is an issue for both of you. Climate risks.
I think it's, you know, I think climate risk is an important issue. I think that it's not, you know, in this, you know, center of what monetary policy is looking at. So it's certainly something that we would be paying attention to in terms of how it affects the, you know, the way the economy plays out from a bank risk perspective. I suppose that could be important, but I would look to, in the US, it would be very important that the democratically elected officials, the president and Congress weigh in and provide more guidance than currently has been, I mean, along the lines of what you're talking about. They have not delivered that type of guidance, and there's an ongoing debate in the United States with different viewpoints on that, and I think that just needs to be resolved.
So let's, oh, sorry. Sorry.
Well, you pose difficult questions, and you only... having said that, you know, something that I think that is important, well, you have mentioned the potential implication of climate change on monetary policy. Well, this is something that, is going to be, you know, part of perhaps, you know, a longer debate. But there is something that is quite evident, is the impact of climate change on financial stability. Theoretically, we have, you know, to move from, you know, a brown economy to a green economy, and this is going to pose, you know, transitional costs to financial institutions. And this is something that we are going to monitor closely, and we are going to follow, you know, in detail, because I think that in the short term, not only for the insurance business, because for the insurance business, it's something that is quite evident, you know. Natural disasters, you know, might happen more often. But, you know, in terms of, you know, the transition, and that the transition is smooth, because if the transition is not smooth, then we can have, you know, some difficulties, no? But in the short term, I would pay much more attention to financial stability issues that should be addressed, you know, by central banks.
Okay. Now, the person in white on that.
My name is John Munnelly. Thanks to all those who contributed to the event today. Both speakers have mentioned the secular decline in pricing. I just wonder, given the quite peculiar 2% target for inflation everywhere, whether it be Japan with a history of never getting anything close to that, whether this 2% target is inappropriate in certain countries, and trying to target it becomes destabilizing.
I get this question a lot, and from your question, I can't tell whether or not you think it is 2%. Is that a high number or a low number?
With reference to your secular decline and a difficulty in achieving the objective, in many areas, particularly the EU and Japan, less so the US, but maybe also in the US, you mentioned issues of demographics. Guindos mentioned demographics, and then other things like IT, disintermediation of the distribution channel and things like this. it seems to be lower pricing. So why have we got lower inflation targets since it's low and stable?
Too high.
He thinks it's too high.
Yes, I think so.
Well, see, so this is, would you like? So I get that question, and it's sort of like, well, you can't hit 2%, you're getting 1%, why don't you just settle in on 1%, or lower? And I think the counterintuitive aspect of this is the problem for monetary policy is that in the United States, when we go into a recession, the typical response from the Federal Reserve has been to lower the federal funds rate by 500 basis points, 5 percentage points, sometimes more. If our inflation objective, if inflation were 1%, and if the real interest rate is as low as 0.5%, well, that only gives you 150 basis points, and then you're going to be doing asset purchases all day long for a very long period of time, and inflation's going to be even lower. And so, sometimes people ask that question and they kind of say, maybe it should be 4%, because then nominal interest rates would be higher. You'd have to deliver on the inflation. And so that is the issue, but I think that that's what monetary authorities do. They provide the liquidity and the monetary conditions to reaffirm and deliver the inflation objective that they're supposed to, and sometimes you have to work a lot harder than that. But in the United States, we've all pretty much agreed that 2% is the objective that we've decided upon. We should continue to work for that. I think that symmetry is very important, because actually averaging 2% best ensures that you have as much capacity to lower rates when you need it. And when, as Luis said, the probability of hitting the effective lower bound is much higher than we realized, it just becomes that much more treacherous. Unless, if the fiscal authorities provided more stimulus, then the monetary authorities wouldn't have to. So, they all kind of work in that direction.
I fully agree with Charlie. Moving to the euro area, well, you need a definition of price stability. Our present definition of price stability, that is our mandate, that's our main target, well, the only target that we have in our remit, is below at close to 2%. And I think that, and this is a personal view, because we have not discussed anything so far, anything in depth in the Governing Council and the Executive Board of the ECB so far. I think that the question is not as much, the concrete number, 2%. I think that, is perfectly valid, as Charlie has said. I think that, perhaps, the relevant discussion is going to be, the question of the symmetry or the asymmetry of the target. That's one thing. But beyond that, well, because the target is important, I think that there is something that, in my view, is much more relevant, is how effective our monetary policy decisions in order to push the inflation, the actual inflation, to the target.
Okay, I think that we are getting very close to the time limit.
Seem to see more hands going up, not fewer.
Yes, I think that we should be done by 12:15. So let me, before Kathleen, before you move to the stage, let me ask a final question to the speakers. Now, last week, there was this working paper that I read, which was published with the title, Threats to Central Bank Independence, High-Frequency Identification with Twitter, in which the authors present market-based evidence that President Trump influences expectations about monetary policy. The paper uses tick-by-tick federal funds futures data and a large collection of tweets criticizing the Fed's conduct of monetary policy. The results show that the tweets have a negative and a statistically significant impact on expected futures federal funds rate. And the conclusion of the authors is that market participants believe that the Fed will succumb to political pressure, which poses a significant threat to the central bank independence. But this is not just a US threat. German public opinion is very critical of the negative rates implemented by the ECB. And many of you have seen the picture of Dracula Draghi sucking the blood of German savers. And I have it here, Dracula Draghi. Right, so under these circumstances, I guess that central banks should devote much more resources to communicating their strategy and decisions, reaching out to the wider public. As you must have read this book by Paul Tucker, Unelected Power, in which he makes a lot of emphasis on the legitimacy of institutions of the state in terms of acceptance by the public. So the question is, how can central banks regain the legitimacy that they had before the crisis? Is there a way in which you can sort of go back to the wonderful days of Master Greenspan?
Yeah, I mean, you know, so in the United States, we obviously went through the great financial crisis. There was a buildup of subprime debt and a lot of leveraging and exuberance, and the banking system wasn't nearly as strong and insulated from that as we had perhaps expected. And so we've undertaken, you know, internationally with Basel III and stronger capital requirements. I think we're in a better position. I think going back to the Maestro Greenspan days, we just need to move on, I think, because there were good outcomes and there were not so good outcomes. The Federal Reserve enjoys a reasonable amount of independence from short-run political concerns. We do get criticized. We get criticized from all types of people. I think that's what comes with the territory when you ask for independence. Then, you know, people, you know, get to criticize you. I think what we have been reminded that we need to do is to keep our head down, to pay attention to our mandated objectives. I say regularly that we are, our charge is to provide monetary and financial conditions to support maximum employment and price stability. If by chance I change my mind and think that previously we were headed for 50 basis points on the restrictive side of neutral to now one where it's 50 basis points on the accommodative side of neutral, that's because as I've looked at the data, as I've looked at my outlook and worried more about not hitting inflation of 2% year after year after year, I think that we've needed to reduce the federal funds rate. Whether or not somebody can calculate a high frequency correlation, I'm just paying attention to the data, and we just have to keep doing that.
Okay. Well, looking at the euro area, in a recent survey, it was a survey that was carried out throughout the euro area countries. 75% of the European population favors and supports the euro. 75%. So I think that is not bad, taking into consideration, the rankings in other policy areas. I think that this is not bad. You have referred to the communication. Well, communication, everything can be improved, and communication for sure that can be improved. But there is something that is quite evident. We are talking about monetary policy, financial stability, banking supervision. This is not the Champions League. I don't know if you follow me. We have to explain to the population. We have to go to the parliament. We have controls, and I think that transparency and check and balances are extremely important. But we are talking about issues that are technical issues that have, an impact on the rank and file, and that's why we have to communicate to them and we have to deal with them. But are very technical issues. And I do not, and it's even curious, because if you look at the recent evolution and the recent performance of some let's say conflictive countries in the euro area, as it was the case of Greece, well, the Greek population didn't want to leave the euro. Even in the case of Italy in the past, that they had some populist let's say tendencies, there even the Italian population was totally in favor of continuing, with a big majority in favor of the euro. I think that perhaps in Europe this is something that is more complicated than in the case of states. I suppose that Charlie has difficulties in order to understand the decision-making process that we have in the euro area, because in the States it's much more simple. There are, in our case, 19 of us. But always in the euro area, not only, I don't refer only to the ECB, I refer to other, we explore, many alternatives, but at the end of the day, we always choose the correct one.
Okay, well, with that note, I think that we can close. It's 11:15, the time that I was supposed to. Let me thank the speakers, and let's now...
I want to thank
words.
the speakers and the moderator, because the kind of material that they left us with is really enough to work on a PhD thesis. So I'm going to try to essentially draw some comments from this, and starting with this premise that in light of low interest rates and lower trend growth rates, as Rafael said, life has become much harder for central banks to achieve the targets. Coordination might be one way to do it, but what is striking is that in the US, when Charlie Evans talked about, okay, the Fed changed policy direction, that now we're in the midst of risk management and so on, it's an interesting construct that at the moment seems to be data dependent, and we are seeing how things are going in a way. Whereas the reality is much more complex in the euro area. Lower rates, natural rate, lower trend growth rate indeed also, but no fiscal support. And it's taking place, and I think this is really one of the major difference, of course, it's taking place during the time when the construct of the euro area is still very much, in my opinion, in its infancy. So that we do have the structural framework that needs to be put in place, as Luis de Guindos did mention, banking union, capital market union, etc., so that it becomes the conduct of monetary policy is indeed much more challenging. And then on top of that, if that's not enough, we've got these downside risks, cyclical, and the Brexit. So the real conclusion out of all this is that if Charlie Evans feels stressed, he should just come to Europe and relax. And based on this, I think that this concludes our session for the morning, and we should reconvene, I believe, on the other side for whomever has decided to join us for the next session, which I think is at 11:30. Thank you very much, and thank you.